Do I need makeup?
No, you're good.
Okay.
All righty. And one, two, three, go. Welcome back to another episode of the Indy Investor Pod. I am Brett Snodgrass, and I am hosting today's show. And today I have a good friend of mine, Joseph Viery, and he is from the U.S. Tax Advisors Group, and he's going to be focused on cost segregation and how you, as a real estate investor, can save thousands, even millions of dollars over your lifetime in taxes, and how you can do that using this amazing strategy called cost segregation. Let's get to the show. And welcome back to another episode of the Indy Investor Pod. I'm with Joseph Viery. Joe, how's it going, man?
It's going well. How are you?
Doing fantastic. Thanks for being on the show today. It's always a pleasure.
It is.
And
Thanks.
really excited. This is a question I get a lot, right? Most often is as a real estate investor, we're supposed to be able to save money on taxes. And how can you do that? And one of the best ways is using a strategy called cost segregation and the details of that. It's for me, honestly, I've been a real estate investor for 13 years and it still is a complicated process when I think about cost segregation. But you, as a group of engineers, this is what you do, right?
Correct. Right. And it can be complicated because the way the IRS has set the table is they want you to be an engineer to be able to perform cost segregation. So that's why my services are needed. Do your listeners know what depreciation is?
Well, some do, I'm sure, and
Okay.
some don't, because again, that's another complicated. Why don't you just go ahead and dive into depreciation and what that involves?
Well, let me set the table first. Number one, U.S. Tax Advisors Groups, we are not accountants. So we work with your accountant, meaning the client's, the building owner's accountant, to perform an acceleration of depreciation expense. And and I'm just going to talk at a very high level, so we're not going to get complicated. Think of it this way: you have taxable income, and you have expenses that reduces your taxable income. If you reduce your taxable income by using expenses in real estate, then bottom line is that you pay less income taxes. And any savvy investor wants to pay as little income tax as possible, keep the cash flow, and invest in real estate. And basically that's it in a nutshell. And so what depreciation is the IRS is saying, okay, Mr. Investor, Mr. and Mrs. Investor, you're using up your building throughout the lifetime. The lifetime for residential is 27 and a half years. Where they came up with 27 and a half years, I've never looked into it. Somebody who has a lot of time can look into why Congress came up with 27 and a half years. It's probably not a very good reason, but whatever it is, it's 27 and a half years. So basically, what an accountant will do, since they're not engineers, is they'll take the building basis. And I want to stress building basis because when you buy a building, let's say you buy a building for $120,000, part of that $120,000 is not depreciable. The IRS will not let you depreciate land. So somebody has to carve out land. The person who carves out land is not Joe in U.S. Tax Advisors.
Hmm.
We can give you tips, we can give you advice, but we're not land appraisers. So the owner of the building or the accountant can do it. And how, just very quickly, there's a couple ways. Number one, if you get an appraisal on the building, sometimes the appraisal will have the land value. If not, then a lot of times the tax assessor, that allocation will work. What we do nationwide is we use a 20%. Now, 20% is not going to work on the beach in Miami, but overall, if you're in Indianapolis, if you're in Austin, Texas, if you're in Alabama, 20% will be roughly what land allocation would be. So using my example, if you take $120,000, you peel off 20% or $20,000 for the land, then you have a depreciable asset of 100,000. And it's simple, divide that by 27 and a half years. So you get a little bit of that depreciation over 27 and a half years. But how many people want to wait 27 and a half years to get their little bit of expense when you can get it all up front.
And that's exactly right. I'm surrounded by real estate investors all the time, and this is still just a strategy that they don't use that much. I was talking to a real estate investor the other day, and I'm starting to buy some rental properties so I can use some of this accelerated depreciation. And he said, well, you don't really get that much depreciation. It's really not even worth it because they're using a strategy of the typical, they don't contact Joe, they use the 27 and a half years, and it is not a lot. If it's $100,000 property, to depreciate that over 20, I mean, you get a little bit each year and that's it.
I don't
It's
even
not
know
that
what it is,
attractive.
but it's not that much. It's basically, I will tell you immediately, it is. I should know this by heart, but I never memorize it. That is $3,600 per year
Yeah. And
versus
that's how
if
much you can write off. Like,
that
so
that's yeah,
so if you're in a
that's what
30% tax bracket, you save $1,000 maybe, but it's going
correct.
to cost you more than, So
Yeah.
anyways, it's just not worth it. So that's why you're so important. Number one, and all the listeners out there, this is so important because your most expensive thing that you will ever spend money on in your lifetime is taxes. It's, because, and we don't think like that. It's because we're not writing a check unless, we have to write one every year. But a lot of times we get this little bit of refund. We don't really see it coming out that much. But it is the most expensive expense that you will spend is taxes, unless you can use these strategies, just like this cost segregation strategy. So, Joe, we talked about depreciation, and now let's talk about what you guys do. So instead of writing off $3,600 on your taxes, what else can we do?
So what you can do is you can take advantage of the new 100% bonus rules, and all that means is any life of the property that is 20 years or less, you can write off the first year. The key for the owner of the building and the CPA is what is the life of a property and what are you talking about? And most accountants and most building owners would never know how to break out a building to find out what the lives of, and that's what we do. We break out the lives of the building and we put them into three buckets: 5, 7, and 15 years, under 20. So everything we find in personal property is an immediate write-off that tax year that you acquire it, the first tax filing. So using my example, the $100,000 building, if I find 30%, you're going to get a $30,000 write-off that first year.
Wow. So you're
Yeah,
telling me that I just bought a $100,000 building, and instead of writing off $3,600, I can write off $30,000.
correct.
Wow. And you do that by doing this cost segregation study. So you talked about it a little bit, but what actually is cost segregation? What is that process? Without getting super complicated, because I don't know all the
I'm
details
not
of it
going to
either,
get
but
complicated.
go ahead.
No, I'm not going to get complicated. So I make it very simple because I use an example which everybody can relate to. If you point down at the floor of where you're at, you probably have carpet. And if you point at the carpet and say, is that carpet going to last 27 and a half years in this hotel, in this single family home, in this apartment complex? Well, you would, somebody would look at you and go, are you crazy? I'll be lucky to last 5 years.
Mhm.
And so basically the IRS has come up with a whole schedule of building components that they put into shorter life. Everything outside the building is going to be depreciated over 15 years or has a life of 15 years. And then interior, it's 5 and 7. So what we do as engineers is we dissect the building, kind of like a reverse dissection, and we break out all of the components of the building into their correct lives. And usually about 30% is going to be in the shorter lives, which you can then write off that first tax year you buy the building.
Awesome.
That's what we
Awesome.
do. We just break it out and we say, okay, this is how much is going to be in carpets, how much is going to be in countertops, how much is going to be in window coverings, anything that we determine is a short-lived asset, which is about 30%. Just keep that in mind. Is what we're going to, and we do this in an engineering report. So the engineers look at the building and break it out and give the client, the customer, or their accountant this report that breaks out the assets of the building.
Gotcha. So you basically take the personal property and the components that you can depreciate at 100%. And is that typical? I mean, you basically said you can, using this strategy, you can depreciate the first year about 30%. You know, you buy $100,000 properties and you said you could write off 30,000, 30%.
About
Is that
that's an
typical?
estimate.
That's an estimate. And is
Yeah.
that typical? I mean, anywhere from 20 to 35,
Anywhere
40.
from 25 to 38,
Gotcha.
40. I usually go low, so I go about 30 because I don't want people. I'd rather lower expectations. So I just use 30 if somebody wants an estimate. Take the building, don't take the land, take the building basis, and 30% of that is what you're going to get in first year write-off.
Awesome.
Now, here's
So
one thing that's important, though, to keep in mind is that remember I said 30%. So guess what you have? You have 70% in the 27 and a half year. That didn't change.
right.
So you're still getting depreciation over time, but you're not getting as much, but you're getting the big bang up front. So would you rather save your cash up front, or would you rather, or not? So you're still going to get your depreciation. It's not like you're going to get zero and you're going to lose 4,000 a year for the rest of the life that you own the rest of the ownership of the property. So that's what a lot of people need to understand, because you're still going to get a big bang in depreciation. It's just you're going to get 30% up front.
Yeah, exactly. And it's just deferring your taxes, right? It's just if you ever sell that property, you still right. Your cost basis for that property is just a lot less now because you depreciated a lot up front. Um, and I tell people it's just a game changer. Number one, I mean, people talk about taxes all the time, but it's not even that first year. It's like, wow, if you could save $100,000 this year, rather than writing that to the government, if you could keep that, you got assets now. Plus, think of how you can grow that 100,000 over the next 20 years. It's just completely game changing your wealth strategies. I mean,
Smart
it's
people like
amazing.
you, Brett, are going to take advantage of that 100,000, and they're going to do a lot with that $100,000 that I
Yeah.
saved.
Yeah, exactly.
If they're
Um,
not going to do a lot with the 100,000, I'll be the first to tell them don't do it. Why bother?
yeah,
If you're going
right.
to put it in a savings account and get less than 1%, then don't go through the exercise. But if you're going to be like you, a savvy investor, I had one gentleman who, I don't recommend this for flippers, but it's a long story. I'm not going to get into it. But basically, he's going to do cost segregation because he can double that 100,000
Yeah.
in 1 year.
Yeah.
So he said, well, why? Well, I don't care. If I have to, if I'm going to sell the building after a year,
Yeah.
I just made an extra 100 grand by you.
I know.
So
I know. And it's crazy. Um, so obviously this can really change real estate investors' life. Just this one thing, it can just change the game for them. So let's talk about what types of properties you can use this cost segregation study on. I mean, I've heard cost segregation studies before. In my mind, it was always on commercial properties. It was always that way. I'm mostly a single family investor or duplex, triplex, residential houses. That's typically what I invest mostly in. And I said, well, if I ever get a commercial property, I could use this strategy, but I I can't do it. It's going to be too expensive for me to do a cost segregation study on a residential home. Um, so let's talk about that a little bit because you guys really have done some creative ways to help out investors like myself in the single family space. So let's talk about that a little bit. What types of properties is this cost segregation study good for?
to set the table, when I started in 2007 in the cost segregation industry, we all did only full detailed engineering based cost segs. And you are correct. We did those reports cost 40,000. And the reason why we were charging 40,000 is because we had to send a team of people out to the building to do the inspection of the building, document all of the personal property, all of the real property. The engineers had to look at plans and drawings, blah 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 blah. And so basically, back in the day, there was nothing we could do for single family homes. You're not going to pay $5,000 for a study for a single family home. The numbers don't work. So basically, we came up with another strategy called modeling, and modeling is approved by the IRS. It's not the top level. The top one is still the full detailed engineering study, but the modeling is still, it's down the list. It's like number 4 or 5. They still approve it. And basically what we do is the engineers will model the building without going to the building. So we look at the building, we use satellite technology, we use all the information we can gather on our end. So we do all the gathering of the information. And basically we use a statistical model, and we're telling the IRS, okay, in this house in Indianapolis, 3-bedroom, 2-bath, 1,500 square feet with a 5,000 square foot lot, this is what we are expecting to find in personal property. And we break it out and we give you the report, and then you can take the acceleration. Now, this kind of study is not good for dispositions. If you want to find out when you throw away the bathroom, all of the stuff in the bathroom with the write-off value, you can't use a study.
Mhm.
This is just overall large breaking out of, okay, this is the personal property, this is the real property, but you cannot get granular in detail to figure out how much countertop is.
Mhm.
Our full studies you can, but not modeling. So it's good for one thing only, and that's accelerating the depreciation.
Gotcha. So the modeling approach versus the full study. Um, you talked about a $40,000 for a full study. Obviously, that's the top tier. That's the thing that really, is solid, stands up. The modeling approach, I don't hear a lot of other companies have done before. Is this something that you came up with? Is this something that you've seen other people, engineers do as well? And you said it was approved by the IRS. And this is
Yeah.
probably what a lot of listeners are asking, if I get audited, is this going to hold up?
Well, number one is we will stand by our word. So if you get audited, you call Joe, and basically we will talk to the IRS and we'll explain. If you get audited for modeling, they'll probably want to delve into our statistical analysis, and we'll explain the statistics behind the scene and how we engineered it in our background. And basically, that's all the IRS will usually ask.
Mm.
So there's no risk of audit from doing modeling. And if the IRS has any questions, we'll be happy to answer the questions. And the $40,000 fee is for a building in downtown Indy.
Mm-hmm.
It's for one of the skyscrapers, the tall buildings.
Mm-hmm.
Nowadays even that's come down. But one thing I do want to touch on, though, just I'm going to take a little segue here,
Mm-hmm.
is that this is important for the listeners to understand, is what we provide is we provide the same type of depreciation expense as the investor is investing in real estate. So if the investor is a passive investor, we provide passive losses. If the investor is an active investor, we provide active losses. So the only time that I find that cost segregation won't work is if you're a passive investor and you do not need passive losses, then do not do cost segregation. And how do you find out? Ask your accountant. Hey, if Joe gives me $10,000 and $20,000 and $30,000 in passive losses, can I use them? And if he says yes, do it. If he says no, don't.
Yeah, exactly. I mean, I come from the standpoint of the active investor. I mean, we have a lot of active income. So
Right.
for us, I don't want to pay as much taxes. I mean, I pay my fair share, obviously, but yeah, I mean, it's really helps us because we need it,
Well, but
I don't want
even passive investors sometimes need passive losses.
to. Yeah.
It's not as simple as that's why you need an accountant to say, hey, yes, you can use them, or no, you can't.
Yeah, exactly. Well, let's I know we're going to talk rough numbers here. So you talked about like $40,000 huge skyscraper fee. Let's go back to that modeling approach, single family home that someone bought for $120,000. What what would be, you're going to write that off. You're going to, take off the land. You got $100,000 building. You might be able to write off $30,000 on your income taxes for depreciation. What's that going to cost that investor though to do this study?
Okay, the fee structure works like this. For our normal fees are $850 and $900. $850 is for a current year report, meaning if you buy a property in 2020 and you file your taxes in 2020, which you must do, then basically that's a current year. If you go back in time, and by the way, I can go back about 15 years and still make the numbers work. If you go back in time, that's a look back study. So we charge $50 more. So it's $900. But for your
Gotcha.
listeners, because of you and your influence, we're not going to charge that. So basically what the fee structure would be $500 for a current year tax, current year study, and $550 for a look back study.
Let me just say that again, because I just want to make sure that we're clear on the actual fee. So I know, did you say it was $850 for the
850 and 9? Yeah, 850 for current
859?
year and 900 for look back. And so your listeners, 500 for a current year and 550 for a look back. And
Wow.
don't forget, my fees are expensive.
Yeah. Wow.
So when I usually do a comparison, I said, well, you make sure you take off the 30% from my fee, because you're not going to be paying 30% because that's a tax write-off.
Yeah, exactly. So guys, if they just mentioned the Indy Investor, heard you on the Indy Investor podcast, definitely reach out to US Tax Advisors Group. That's awesome. Thank you so much. So again, I just want to kind of go back to that to get $100,000 property, and you can write off $30,000, which, if you're in a 30,000 or 30% tax bracket, I mean, you're a math guy, Joe, but what are you looking at? So you can write off what, $9,000?
So if I give you a $30,000 write-off and you're in a 30% tax bracket, you're right. That's $9,000.
$9,000.
And then you're going to pay me $500, right? And
Yep.
$500 less 30% is $350. So my value proposition to you is that we're spending $350 to save $9,000.
Yeah. And I ask all you investors out there, I mean, how many people would spend $350 on marketing to make $9,000 on a deal? I mean, a lot. Everybody.
And now here's one thing, is that back in my day, cost segregation, the first question I would have is, this must be a scam. This can't be true. Okay, we're way past that now.
Yeah.
So nobody says this is a scam anymore because it is so widely accepted. So don't worry about that. The IRS does admit that this is the correct way to depreciate a building.
Yeah. So Joe, I want to ask you, we've talked a lot about the benefits. Obviously you can save a lot of money on your income taxes. We talked about, what are some of the drawbacks? Could this red flag an audit? I mean, have you seen that? No. So we talked about that. What are some of the other drawbacks? Like you said, maybe you don't need the losses, right? So if you don't need the tax write-off, this isn't the thing to do. What are some other drawbacks when someone might not use this study?
The only drawback, and it's not a major drawback, is that there is a concept in depreciation called depreciation recapture. So remember when I said flippers shouldn't do, we recommend you're going to at least own the building for a year and a half minimum. Mm-hmm. And so bottom line is, if you think you're going to be selling that building in a year and a half, by the time you factor in depreciation recapture, I would say, well, why are you even spend the $350? Now, this person who's doing it, this other investor he has other issues that make it worthwhile. He's a flipper, but he's mm-hmm. going to actually hold his properties for at least a year to make the mm-hmm. numbers work. So I would say if you're not going to hold the property, you have to look at depreciation recapture. Now, what we do reduces depreciation recapture. So again, it's a benefit. But I would say that's the only objection I can come up with, is if you're not holding the property long enough to make the work. Or again, if I give you $1 and you can't do anything with that dollar, I would say again, don't do it.
Yeah. Yeah. Is there certain types of properties that wouldn't fit this? No. No.
Oh, but here's one important thing, is that the basis of the building to do modeling and this is our decision. My engineers have decided that we are going to not do a building if the basis is over 500,000.
Gotcha.
So okay. Across America, that works just fine. Mm-hmm. If you go to California, that's not going to work just fine.
Yeah. What when you look at the cost basis, is that mostly the purchase price of the property, or I guess if you owned it long enough, then it wouldn't be. What if you bought the property in 2020? Do you base the value on the purchase price minus the land?
Yeah, and everything is what's recorded with the IRS as the acquisition price. So in other words, a lot of misconception. That's a good question because a lot of people go, "My building's worth $1 million." No,
Right. Yeah.
the IRS doesn't care. You
Yeah.
bought your building for 250 grand.
Mm.
That's all they care about. That's
Or the
all.
appraised value. If you got it, like, let's say you bought one, but you put a bunch of money into it, then maybe do you appraise it?
Well, now we're getting a little bit complicated. Here's what we do with modeling with a full cost seg. I can look at those expenses no matter when they were made.
Hmm.
But let's say you buy a building and you do the improvements, and I'll do this quick. Let's say you buy a building January 1st, it closes. It's rented, and so you keep it for 6 months, rented. And then when the tenants leave, you do another 10, 20, $30,000 in improvements. I can't look at that 10, 20, $30,000 and model them.
Mm.
I can only model if you buy the building, you do the work, and then you put the building in service. I can look at the 30,000. So now instead of 100, I can look at 130. But if there's a gap in between and you put the building in service and then you put the improvements in service a different date, I can't look at those. I have to disregard the improvements.
Gotcha. Okay. Gotcha. That's good. That's a good thing to note. Last question. I think this is my last one. So I had an investor talk to me, let's see, yesterday actually, and their question, their accountant told them that they weren't really talking about cost segregation today. They're really talking about if he wanted to pay zero taxes, he had to buy $200,000 worth of rental properties. And he said, okay, well, I'll just buy, a few $70,000 properties. But his accountant says, no, you have to actually have $200,000 worth of construction costs. It can't be the purchase price. It has to be like your what you rehab the houses with. Anyways, that confused him. It confused me. And I told him while I was talking to you today, and we're talking about cost segregation studies, and I don't think he said he didn't even have that, but was it just, I don't know. Like, do you have any thoughts on and feedback on that investor?
The only thought I could have is if he was trying to say that land is not depreciable, and
Mm,
you have to have construction costs, meaning building,
mm-hmm.
because for us it makes no difference if it's new construction or if it's an acquisition. Like I said, 20 years, 15 years, I make the numbers work. 15, 20 years is a little far. 15 years, I can probably make the number work because what we're doing is we're calculating how much depreciation you've already taken,
Mm-hmm.
and you can't double dip. So you've already taken a bunch of depreciation. I got to give you the acceleration. It's got to make sense after you pay me. So that's what we calculate, and then we do that with no cost. All I
Mm,
need is a couple of answers to three questions. How much did you pay for the building? What date did it close? And the address. Give
mm,
me those three bits of information. I do the first work without the fee, and I let you know how much money I can save you. And and we've already talked about the fee. You can already figure out if it's worth it to do on that building. But no, I don't understand what he was referring to because to me, depreciation. If you bought three buildings worth $70,000, would work just as well as if you bought one building for 210.
okay. Okay. Awesome. Well, if you're listening out there, that investor, then reach out to the U.S. Tax Advisors Group. Joe, it has been a blast, man. I appreciate you. I know there's other things that we could dive into. Obviously, that's the most common strategies. There's also a couple other studies. Can you just kind of touch on them before we end the show? Because I know you do the full scope study, you do the modeling approach, you do a couple other things too.
Energy studies is the next one. Basically, if you do any improvements to the building, the upgrade the efficiency of the energy, meaning obviously gas and electric, then there is a tax credit, and so we can do tax credits for single family homes. There's a little bit of a wrinkle because it really this one does require my engineer to travel a bit. So if it's just one, that may not work, but we would still look at it to see what we're looking at. But basically, if you do these energy upgrades, and when you do improvements, I will tell you right now, most of the time an investor does improvements, you already do. If you buy anything like an HVAC system or lights, they're already energy efficient.
Mm-hmm.
You really can't buy anything on the market nowadays without it being energy
Yeah.
efficient. It's just
Right.
not out there. So if
Mm-hmm.
you do any type of work, you're probably going to save on energy, and you probably would qualify for that tax credit.
Okay. Awesome.
So
Sounds good, Joe. Any other last words? I mean, before we wrap up the show, and I want to get your contact information too, as far as where can someone go to find out about your company?
no, I think we did a great primer course. We did an overview, and we touched the most important parts. The next question would be, or the next uh, recommendation would be, go back to your accountant and tell them what Joe can do. And if he says, well, let's get an estimate, then I'll do the next step for no charge, and I'll give you an estimate, and then you guys can huddle up and decide whether it's worth it and you need the extra deductions or not. And to contact U.S. Tax Advisors Group, it's www.ustagginc.com. So
Awesome.
USTAG, U.S. Tax Advisors Group Incorporated.com. And my cell, if you want to call me directly, is 619-548-1990, 19990.
Awesome. So the website, it was, and make sure you guys write that down. The website was USTAGINC.com.
Yes. Mhm.
So check that out, guys. Just, hey, it never hurts to get an estimate. I know I've used Joe and the U.S. Tax Advisors Group. I think we did 5 or 6 maybe last year. And I just said, hey, what can you guys save? I think we spent maybe $2,000 or $2,500. I think we ended up saving maybe 18,000 or 20,000, something like that. So it was definitely worth it for me. So I just highly recommend it. I mean, if you're like me, you don't have to pay, we already pay our fair share of taxes, and we feel like, I feel like I can be a better steward with my money than the government sometimes. So I
I,
don't know.
I deal with big guys. I mean, I deal with small. Like, I'll deal with a $50,000 home in Alabama.
Mm-hmm.
But the point is, I deal with $1 billion buildings.
Mm,
That downtown Macy's men's building in Union Square, San Francisco, is one of my projects.
mm,
That's full engineering, of course.
wow.
And so it's a lot of work. But what do people like that have in common who own it? They all are like the president of the United States and his
Yeah.
following, is that they don't want to pay taxes.
Yeah.
So bottom line is, smart investors know you try and keep as much as you can and get that money to work for you. And all of the big players out there do cost segregation.
Yes. Amen. Amen. Well, guys, thank you so much for joining us on the Indy Investor Pod. Joe, thanks so much, man. Just a pleasure. And I think you gave so much information. Make sure you reach out to the U.S. Tax Advisors Group, right away. It's that time of the
It's that
year.
time.
It is that time. So make sure. And then one last question, Joe. So 2020 is getting ready to end. Um, Once 2020 is over, can someone, let's say can they go back to you and do a previous? I think you mentioned that earlier, but they can pick some properties up, and if it's after 2020.
Here's the deadlines. The deadlines are when you file your taxes.
Okay.
So there's four dates: March and September. March 15th, September 15th are for entities. If you own your building in an LLC or an LLP, you're a March or you're a September filer. If you don't, you're an April or an October file. And a September, October is obviously extensions. So bottom line is, we have plenty of time. You just need to get to me before you file your taxes. Once you file your taxes, now you are a look back study,
Mm-hmm.
because you've
Gotcha.
already filed the tax return on your building, and the IRS knows how you set your depreciation. So now you have to do another form called the change of accounting method form, which is not a big deal. It's just, that's why it's $50 more,
Mm-hmm.
because now it's a look back study.
Yeah.
So anytime before you file your 2020 taxes, I would say give me at least 30 days.
Okay. Awesome. Sounds good, Joe.
All right.
Well, again, it's a pleasure. Thank you so much, guys. Check out the U.S. Tax Advisor Group with Joe Viery, and thanks again.
You're welcome. Thanks, Brett.
All right. Let me just.